The market bottom is coming in 2 days. It's now official. The forecast for US recession within 1 year is 100%, meaning that there is near certainty for a downturn along with tightening conditions and inflation. JP Morgan is now forecasting a fall of 20% of the stock market. So let's dive deep into how we're going to crash land and what we can do to make some money from this opportunity. And now is a part of the video where you take control of your future by smashing the like button, subscribing, and ringing the notification bell so you don't miss out on awesome opportunities to watch my videos and make money in the future. And make sure you watch till the end, as there is a hot tip waiting for you all. And now that you've done that, let's jump into the video. So a good place to start our understanding of recession is that the way down to the bottom is going to be a choppy ride with many rallies along the way as well. Yeah, you heard me right. Rallies is actually, in fact, what I did say. Wall Street is seeing a potential of 16% rally on the back of earnings season, which may signal the beginning of the bull market, but let's not jump to that conclusion too soon, because these rallies have a special name. They're called bear market rallies. That's right, bear market rallies. Where on the way down, the markets experience small to large bounces, and we often call them dead cat bounces as well. And looking back into history, the GFC had 9 bear market rallies, ranging from 7% to a whopping 24% rallies, with the bottom occurring after a whole lot of 2 years. Yes, that was a long bear market, that one. And these bear market rallies are so strong that if you were to have bought the top and sold the bottom of each rally, you would have lost a whopping 80.25%. And this, ladies and gentlemen, is the result of FOMO. But the occurrence of the bear market really isn't for the GFC only, as it has existed in almost all bear markets throughout history. Every bear market between 1901 and 2015 formed at least one 5% rally. Rallies of 10 or more interrupted 2/3 of the 21 bear markets over the last 115 years. The dot-com crash was no exception either. Here you can see the bear market rallies have occurred very frequently, with the biggest rally occurring at 56% on the Nasdaq during the same period. So it is very difficult to measure when the bottom is in, whether it is just a bear market rally or an actual bottom. So let's take a look at the current market. We have been falling and rising since the end of December last year, and with a couple of bear market rallies clocking in around 7 to 17%. And so we can clearly observe that what the market is doing right now is exactly how markets have behaved in the past. Now, Michael Burry, the darling of the bears, confirmed this observation by saying 12 of the top 20 Nasdaq one-day rallies happened during the 78% drop from the 2000s top. 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top, which indicate that bear market rallies are strong, if not stronger than those found in bull market. Looking also at the VIX, the volatility index, the indicator has been consistent since the late 90s to be able to mark out the bottom of the market. And as you can see, we have a bit more room to go, with the lowest peak VIX reading showing at least 40 when the dot-com bubble popped. Now, Michael Burry attracts us to another indicator, saying that currently 13.48% of the stocks are above their 200-day moving average. And it is typical that market bottoms occur when that percentage is around 5%, as you can see on the graph, which occurred for the GFC and the 2020 crash, with the odd exception of the dot-com bubble crash. And what I could attribute to what we're seeing in the dot-com crash is that there was an overvaluation of tech stocks back then, and investing in companies without any income was more common. And as the name of the crash suggests, any company with a dot-com on it would attract investors like crazy. Similar to how last year, remember, any crypto project with the word Metaverse in the pitch deck did super duper well. And so check this warning out from Michael Burry, because he seems to think that there are too many money losing companies and they are very overvalued in the S&P 500, because the S&P 500 has 218 companies valued over $1 billion that are losing $100 million per year or more, and 29 of them are over $10 billion in valuation, totaling $655 billion in total, which puts the average value of each company sitting at around about $20 billion. And the list of companies that Michael Burry is referring to will probably shock you, because it includes Snowflake, Uber, Shopify, Rivian, and Lucid, just to name a few. This kind of issue exists and has existed similarly in the crypto market, especially in the Metaverse crypto space, as last year was the year where any crypto project with the word Metaverse would soar to the moon, such as Victoria VR. You can see here, it soared to some tune of 208x on day one. Now, Victoria VR is now down some 98% from the top, and projects such as Sandbox and Decentraland, which are the darlings of the metaverse industry, they have both attracted more than $1 billion in market cap, and it only has less than 1,000 visitors to the metaverse each day, which makes the metaverse look pretty damn lonely. Now, bringing it back to the conversation of stocks, Burry also highlighted what is called money velocity. Velocity of money is a measurement of rate at which money is exchanged in an economy. And so if a burger shop had $50 and went to the butcher to buy some meat, and then the butcher spends the same $50 to buy some feed from the farmer, and the farmer uses the same $50 to eat the burger from the burger shop, the original $50 has bought $150 worth of goods by changing hands 3 times. The velocity of money here is 3. And the way this is calculated is dividing the turnover over the money supply, or in this case 150 divided by 50. Or in the case of a country, the GDP over the money supply. And so according to Michael Burry, what you will observe is that velocity of money has been ticking up, which he then continues to say that it will lead to a higher and faster circulation of money, also known as higher velocity of money, which by concept does lead to a higher inflation. But here in his tweet, I want to highlight that I don't necessarily agree with how he got to this conclusion. The rest of YouTube just brushes over this detail, but I do want to point out that this tweet has a couple of misunderstood concepts. And before you say, how do you know, who do you think you are, in the comments, just hear me out, okay? First of all, the tweet assumes that quantitative tightening and higher rates reduce money supply. Well, it may not. Quantitative tightening is just a monetary policy which comes by way of increasing interest rates. It can have an impact on the monetary supply, but if the rest of the government policy is geared towards cutting student debts, pushing foreign aid, which comes back into the country, and investing bulk cash to green energy companies through the ironically named Inflation Act, then speculatively, money supply may not drop as much as one expects. By the way, if you want to find out some more information about what I just mentioned, then you can find the video that I posted a couple of weeks ago, which looks like this. Also, I don't know what is going on in Michael's head, but there is nothing surprising about reducing M2, which pushes up the velocity, meaning there's no reason for the word yet in his tweet. Just let that sink in, have a think about it. And secondly, the metrics in the velocity equation is a lagging indicator. M2 is lagging on the interest rate, and GDP isn't calculated instantaneously. Either way, I'd like to criticize that this tweet is highly theoretical, which may play out as it says, but economy doesn't always work this way. And yes, from this tweet, he then goes on to make an observation that inflation never really makes one peak and disappear. Rather, it makes 2 or more peaks since the 1940s. Again, here, I don't think the issue with controlling the inflation is borne out of some metric like Michael Burry seemed to think so, but it's got more to do with political audacity to be able to smash the economy, to tackle the inflation in one king hit, where yes, the economy will unfortunately suffer a lot, but the economic world takes a humble seat to where it belongs that match their work ethics and production outputs. So overall, Michael Burry is saying that there is more room to crash, and once it gets to this level, then the crash cycle is going to be more elongated. So what we can expect is volatility moving into the future. And of course, no one can really know when or what the bottom is going to be. So how do we make money from this information? Well, first of all I want to help you understand is that more people lose money trying to time the bottom of the market than those who don't. We are at a level in the market which is still quite attractive to invest in, rather than speculating when the bottom will be in or not. These are the times to keep an eye on the market. I'd rather you pay attention now to the market than when everyone is in the state of euphoria, meaning in the middle or towards the late end of the bull market. And just in case it doesn't really pan out, having some exposure to an affordable and sensible level of investment is a healthy way to stay curious and be both financially and intellectually invested in the markets. Second, you need to work. Stay employed, keep running your business, and offer better services. Accumulating cash in this time is so important. If you are someone who has money when the market bottoms, well, hey, you are in the right position to make lots of money. And third, this is the bonus, guys. If you stay till the end of the video, thank you so much and congratulations for making this far. And if you are one of those people that want to time the bottom, well, listen to this. You want to at least stay close to the bottom, right? So what you need to be is educated. Here's something I've been looking at. We all know that the increase in rates is quite detrimental for assets. Regardless of money supply, the hike in Fed rates just gets priced into the markets. And increasing rates have triggered recessions consistently, which we already know. And we look at things like the 10-2 yield curve flipping to expect when market will begin to crash. But do you ever consider where the actual bottom is going to be in relation to the metrics that we look at? Well, take a look at this, guys. Marked out are the bottoms of the market at its deepest troughs. It occurs after the reduction of rates fully digests the previous hike. And currently we're in a sharp incline of the interest rate hike. So to think that bottom is in right this very second is indeed premature. Again, this isn't the crystal ball Palantir of the future, but this has been quite consistent and very conceptually matching of the monetary policies and the market. Imagine when the market turns from bear to bull, do you think the interest rate will be low or high? When rates are sitting near zero, well, that's a no-brainer. And with the end of the hike not really in sight, we may have to wait just a bit longer. But that gives us more time to accumulate cash. So if you were to ask me when the bottom is in, I think the bottom is likely to be in between 6 to 18 months away from now. And during these periods, I'll be keeping an eye on the interest rates. Liquidity is what we need.